Hey, Paul Morrow again, Smart Financial. I'm here to talk about 3 big tax-free gifts that you can get. They're the same tax-free gifts, by the way, that are given to everybody in America. It's an investor or a saver, and we'll go into those in detail. You can go ahead and hit the button there and subscribe and stay up to date with us on the things that we're doing, including we're having some book signings. My second book, Smart Financial Longevity, is out. My first book, Smart Financial Grandparenting, is already out. And the third book on Smart Financial Wealth Building, it'll be out this summer. We're doing some live signings and meetings and even some webinars. So stay in touch with us. Feel free to ask some questions, post some questions down below, and we'll be happy to answer those for you. But today's topic are tax gifts from the IRS. And these are really big gifts. And I know that IRS provisions are constantly in change. Many of you know that I ran a financial practice for about 50 years before I went to this writing and education period, which is my second act. And during that period of time, we had in 50 years, 47 tax changes. So if you don't think taxes are going to change, then you're not paying attention. Every administration comes in, they want to have some tax changes. Some are good, some are bad. I don't want to get political about it, but these are the things that are in effect today. And there are 3 huge tax gifts. So let's talk about number 1. By the way, at the end, if you want to get a copy of the takeaways, just stay on. I'll summarize it at the end. And then also you'll have an opportunity to download these and get a little checklist on this particular video about the takeaways from the 3 big tax gifts. Okay, number 1 tax gift. If you're an investor and you think that the only thing that you can get tax deferral on is your 401k, your SEP, your IRA, your UDK, whatever, let me straighten you out. The best tax deferral in America is buying a stock, letting it grow. It grows from your $100,000 investment to $1 million, and it's all tax deferred. Not only is it tax deferred, it's capital gains taxed at the end if you keep it long enough, rather than ordinary income. So one of the greatest tax gifts in history is the tax deferral on the growth of stock. Now, that's been around for a long time. People forget about it, and they really get unreasonably wound up about their IRAs and their 401ks. But it's most important when you're planning your portfolio management for yourself, and you meet with your own financial advisor and your own tax advisor, that it's much healthier to end up at the end of your life with half of your money in those 401ks and IRAs and pre-tax plans that have a tax mortgage on them, and the other half of your money in what's called non-qualified investments. It doesn't mean it's a bad thing that they're not qualified. Non-qualified means not an IRA, not a SEP, not a UNIK, not a 401k, nothing that has a tax string attached to it. They're non-qualified, they're liberated, they're just a chunk of stocks or stock funds that you bought that have accumulated over the years. The optimal mix at retirement is about 50-50. So if you have a $4 million retirement puddle and it's $2 million in your 401k and $2 million in your non-qualified money, you can actually do a little bit of cocktail blending of what your taxes look like later in life. So the number 1 gift from the Internal Revenue Service today, anyway, is the untaxed realized gains. That means that as your portfolio grows, you're not taxed on those. Now, there are some proposals in Congress to tax unrealized gains on people who have over $100 million and all sorts of other sort of asset classes that puts them way at the top of the 1% of 1%. And those really aren't the clients that I'm talking to. They're not listening to this video. They don't need to get any advice from me. But for the average working person, I think your tax deferral of unrealized gains is safe. I think it's going to be safe for this foreseeable future anyway. I could be wrong. If I am, I'll eat some crow over the next couple of years. Next, so number 1, if you're investing in stocks or stock funds and they just grow, right, those babies are completely tax deferred. Now, the second thing is, what do affluent people do when they have a portfolio and it's grown a lot and they don't want to sell and pay the capital gain tax? I'll tell you, the second big gift from the Internal Revenue Service, number 2, is that a loan against your portfolio is tax-free. Okay, let me say it again. If you have $1 million portfolio and you want to get $500,000 to buy your new condo in Tampa or something, right? You can either sell it and pay capital gains, or you can borrow against your own portfolio. Now, a lot of brokerages have portfolio loan facilities, right? They have a lot of different names, but basically it's like a passbook loan on your stock portfolio, right? So if you have a stock portfolio or a stock fund portfolio, you can go to your brokerage folks and say, I want to borrow $500,000 against that, okay? The money you borrow against that does not constitute a sale. It's a loan. It's like a loan against your house. It's like any other loan. Loan proceeds are tax-free to you, okay? And the second thing about it is, if you happen to have a dividend-paying portfolio, and let me pick on Philip Morris or McDonald's or some of the big dividend-paying stocks. So if you have a dividend-paying portfolio, like say McDonald's, and it's paying out like 4 or 5% in dividends that you would normally be putting on your tax return, any loan interest on your loan offsets the taxes on the dividends in the portfolio. Now, this is a huge gift. This is part of the reason why affluent people almost never sell their stocks. They invest in them, they borrow against them over their lives. Sometimes they manipulate their portfolios actually so their dividend yield equals what their loan interest cost is, right? So they end up having a net near zero cost to borrow against their portfolios, and they keep them forever. So the first part, tax deferral, is natural for stock appreciation. The second part is borrowing against your portfolio is a non-taxable event, right? And if your portfolio is properly structured, right, the loan interest charges that your brokerage company charges you, right, are offset by the dividends that are paid on that portfolio. So it's like a self-canceling little situation. Now, the third thing about owning a stock portfolio, the third big gift from the Internal Revenue Service is that if you've invested over your lifetime and you're a successful investor and you've got in that $2 million portfolio a whole bunch of stocks and mutual funds that cost you maybe $500,000, right? And you've made $1.5 million in profits. You could cash them out and you could pay the capital gains and put that money in your pocket or give it to your children or give it to your grandchildren. But I will tell you, in my first book, Smart Financial Grandparenting, one of the most important chapters is how to leave an appreciation stock portfolio to your grandkids. These little people in the bottom here can inherit your entire stock portfolio. If it's properly structured, owned by you, passes through your estate, and goes to them, they get, under current tax law now, a complete step up in basis. So what does that mean? That means that this little person with her grandparents could inherit that $2 million portfolio. She could be not interested in stocks. She could be the kid that wants to buy her a place in the mountains of Colorado. She could sell the whole thing and not pay a dime in taxes. This is really important. Step up in basis applies to real estate. It applies to stock portfolios. Right? It applies to an asset that passes through your estate. Now, the one little caveat on this is you need to make sure that if you are a successful investor, that you've done estate planning work and you have what are generally referred to as revocable trusts or revocable trusts that own these things. They should be in a trust that passes through your estate, not through probate, but through your estate, so that the federal government can look at that and say, okay, you put $500,000 in, it's worth $2 million on the date of death. That's the new stepped up value. And then when your little granddaughter takes that portfolio out of your estate at the time of your passing, she is able to sell that portfolio for 100% of the value on the date of death. Now, if she keeps it longer and it grows from 2 million to 3 million, she'll have a tax on the extra 1 million, okay? But most commonly, children will take advantage of the step up in basis to release some cash from their parents' estate or their grandparents' estate. And what's cool about that is she could release that cash, she could deploy it to other investments, she can buy that mountain house in Colorado or do whatever else. There's no strings attached. It's not like inheriting a 401k. It's not like inheriting an IRA. It's not like inheriting a Roth that has minimum distributions. It's completely free of strings that are attached to it. I'm going to give you a little bit of a recap on this because these are 3 and almost 4 super tax gifts from the Internal Revenue Service. So The number one tax gift is that stocks have unrealized gains that are naturally tax deferred by their nature. They can grow and grow, and you won't, under today's law, pay any tax on the growth of your portfolio from $1 to $1 million if it's just stock appreciation. Number two, loans against your portfolio generally are completely income tax free. That's the second big win. And I would say part of that is also that if you're charged interest for the loan, which you will be by your brokerage company, that interest cost is offset by the dividends. Interest cost on a portfolio is deductible against dividends. So if you get a $5,000 batch of dividends and you have $4,000 in interest costs, you only pay tax on $1,000, okay? So that's kind of like tax win number 3.5, right? And then the last big win is what we call step up in basis for that stock portfolio passing through your estate. Now, this is very handy because under today's rules, again, the estate tax limits are very high. It's about $23 million per couple. So there's no reason why you couldn't or wouldn't pass that portfolio through your estate, probate free, in some kind of a trust environment, generally referred to as a revocable trust, that gets step up in basis. Make very sure when you're meeting with your lawyer and your estate planning team that you do not put it into the types of irrevocable trusts that don't get step up. So in order to preserve this big win, we want you to get a revocable trust to hold your stock portfolio, to protect it. Think of it as like sort of a protective wrapper around the portfolio. It exempts you from probate because trusts don't go through probate. However, it is creditable for step up in basis. You want to get step up in basis of death. So those are the 3.5 or 4 big wins that are gifts from the IRS as of today. These are the things that are in effect for regular folks to be able to get 3 or 3.5 big tax savings on your portfolio and your investments. I'm Paul Morrow. This is Smart Financial, and I'd like you to follow us. Go ahead and subscribe to the channel. Stay in touch with us about our meetings that we're doing in New England. We're doing some book signings. My first and second book are out. The third one's coming out this summer. If you join us for either one of these live meetings, we'll give you a signed copy of the book. If you join us online at one of our webinars, we'll be happy to send you an ebook copy on us. And I'll see you again next time on Smart Financial. This is just the art of being smart.